Hi, everyone. Welcome back to another episode of For What It's Worth with Jeff and Ben, where our goal is to really just share what's on our mind at this moment. Jeff, leading into this, I was spending a little bit of time kind of preparing for this and thinking about what's going on. And I started to do a Google search trend. If anybody's ever played with that tool, kind of interesting. So I typed in all kinds of different things, AI bubble, etc. And it's interesting. Sometime around this summer, AI bubble absolutely caught the trend, which makes sense because it's
Everywhere.
everywhere in the financial media, right? Absolutely everywhere. And the trend line is just like a hockey stick as of this summer. So it's clear it's on everybody's mind. And, we talked about it last month and we're going to add to that trend absolutely again this month. So
Yeah, I'm getting tired of talking about it. I am.
I am. Yeah. And that's why I was thinking about it. So actually I was traveling this week and I was on a plane and I started to play with this where I had a little spare time. And that's where I was like, yeah, this makes sense. Everybody's talking about it. If it wasn't trending, I'd have some questions for their tool probably.
Is this
So
going to be our last conversation about it?
I sure hope so. Right. I sure hope so. And obviously I hope it doesn't end in a bad way that we have to have a
Right.
discussion about the bad side,
It
but
probably will, but
it's inevitable. Right. So what I thought we would do today, though, is start to distinguish some differences between types of
yeah,
bubbles.
it's
Okay,
important.
I think that's a really good. I think it's a really good way for us to understand how can this end, like what kind of problem would I face as an investor. And again, this is just what's on Jeff and I's on our minds at the moment. So Jeff, you've used this phrase before. I'm sure a lot of the families we work with have heard you say this before, especially relative to 99 or 2008 with two completely different types of bubbles. 99, as we talked about in our last episode, it's an asset bubble, right? So you have a lot of money chasing very few assets. You start to see things like, leverage or margin usage, right? So people kind of think of it as if I'm out there buying goods, I've used up all my cash. What do? I put it on a credit card because I still want more. Same concept in investing. If I've invested all my cash in that theme or that area that's hot at the moment, but I want more, people start to use margin, right? They borrow against their assets, they get leverage, and they can buy more than they even have cash to cover those purchases. So that is usually a decent sign of, I would say, an asset bubble building. And we saw that back in 99. That's one thing that we can draw a correlation as where our last discussion, we were kind of drawing some distinctions between the types of businesses and where maybe we saw some differences. That's one thing that is lining up pretty close. Margin levels in the market today are approaching those kind of levels that we saw back in 99. So maybe could you make that case for saying, yeah, we've got more money chasing a very small set of companies out there where you're kind of see that asset bubble brewing. And obviously the sentiment, so how people feel about those companies, we see it every day. And again, Jeff, this is where you help remind me of the experience you had through 99 and 2000. You would ask a portfolio manager about these companies and they would tell you every reason why it's okay and this is normal and
Absolutely.
right.
Absolutely.
They're going to explain away all the concerns, which obviously just generates even more optimism for a very small subset. So I think all of that stuff is lining up. But again, when we think about that asset bubble, that does not have to be catastrophic for an economy overall. It tends to hit a small subset. And it also tends to, unfortunately, it hits the people that put the capital into those businesses, right?
Right.
But it's not this system wide problem like we maybe could define with 2008, where, you could say it started as an asset bubble in housing, but then it spread its way into the banks, right?
Yeah.
And as it spread its way into the banks, what did we build? We built a different type of bubble, a debt bubble.
And that's the bad bubble.
That's the bad bubble. And so that's where I think our concern comes in. So again, sharing what's on our mind at the moment, it's not that we're going to be cavalier or dismissive of the asset bubble in the AI area, but when we're running portfolios for families, we can manage around that, right? There were portfolios, there were asset classes that did fine through 2000. Was it great? Is it what we've experienced over the last few years? No, but you can manage through that scenario when it's not a system-wide problem. When 2008 shows up, is there anywhere to hide?
No, there isn't. And I think that is where our fear is, right? And if we do have two very good bubbles, past bubbles that we can look at. And truth of the matter is no bubble is good, but again, there are bubbles that are isolated in a certain area. But when you do make that crossover and you start pulling in debt, you start pulling in leverage, you start pulling in the banks, then it becomes a situation where the plumbing of the financial system becomes at risk. And that's when things seize. And
Yeah.
that's where things start to become very systemic throughout the markets as a whole.
Right. That's where you and I and the rest of our team have started to spend some time of understanding, do we see that kind of leverage in the banking system starting to build? You know, I would say it's hard to find that, right? It's not nearly as evident as the asset bubbles. It gets a lot harder. I mean, honestly, that's where you go back to 2008 and the folks running the bank, they didn't even realize what kind of exposure they had. So if the folks running the bank didn't know they had it, it's a big hill to climb for us to figure out if they have it. With that being said, though, I think one thing that I've spent a little bit of time on here recently looking into is how is all this capital expenditure by these big companies, the Googles, the Microsofts, the Facebooks, et cetera, how are all these companies funding all this capital expenditures, right? Because the capital expenditures are what is driving this market forward, is driving the AI theme forward. And so where is the money coming from? I mean, you hear these massive numbers, the $300 billion or so. Last week, I think it was Facebook or Meta, whatever you want to call them now, they mentioned, hey, we were expecting to spend about 70 some $billion next year on this continued build out and capital expenditures around AI, but now they're ramping that up even higher, which creates some concerns. And again, the question is where is all this money coming from?
What's interesting about that, when we're talking about Meta, is the build out that they are going to use going forward, they can't handle it with free cash flow anymore. And so part of that announcement was they were going to the capital markets to borrow money. And what's interesting is their stock is down about 25% from that announcement. And it's simply the market looked at it and said, whoa, wait a minute. You're now hitting the debt markets. This is where we start to get worried.
And that's where I'd say it's the first crack, right? We're
Yeah,
we're
absolutely.
far we're far from the finish line here, right? So don't get our comments wrong by any way, but it's the first crack that you see. And when we look more broadly at a lot of those large companies, a lot of the capital expenditures are still being covered by free cash
Free
flow.
cash flow.
But that free cash flow, because of the money that's being spent, is starting to shrink. If you're just to look at some of those large technology businesses where they used to just be absolutely flush with cash, had so much cash coming in, I would say it was almost a question of what the heck are they going to do with all this cash? Well, now they found a place to spend it and they are spending it. And actually, I heard a stat the other day that I believe it was as of this quarterly reporting, year over year, this is the first time that kind of that group of companies as a
Mhm.
total have negative free cash flow growth. That doesn't mean they don't have free cash flow. It just means their growth of free cash flow year over year has gone down. And it's because they're spending so much money. So again, you're starting to see some of these things build a little bit, right?
Yeah, and the other thing that we're looking at also is kind of this incestuous relationship between these names. And ChatGPT is a OpenAI is a great example where that still is a private company. We don't have a lot of visibility into what their balance sheet really is, and yet they are entering into all of these different relationships with Amazon and Oracle and NVIDIA. And the question really becomes, how are they funding that? And we're hearing more and more that private credit, and private credit is just basically off balance sheet loans, if you want to say, where the banks really have not lent directly to these companies. These companies have basically gone to the market and have raised that capital themselves through private investors.
Mhm.
And, again, this is another area that we start to have these concerns with is there a weak link in the private credit market that is flowing back to these companies? And to the very beginning point that you had, it's the leverage, right? The leverage is where we start getting concerned, and the debt markets moving into the debt markets.
And that leverage, I think this is an important point. I heard this from an asset manager that we work with. They pointed this out in a discussion that we've never um, we've never gone through a moment where you see a lot of leverage build in the system broadly that didn't end poorly. 2008 is not the only example. Ton of examples back through history, including the late 90 time that Jeff, you would have been working through this during that time as well of long-term capital. That was a buildup of leverage in hedge funds. So again, it doesn't even have to always be just in the banks. It was a buildup of leverage in hedge funds that ended very poorly,
And
right?
that was a very, yeah, absolutely. And that was a very interesting August of 1998. I will never forget it. It was one of those pinnacle moments in my career where, quite frankly, it came out of left field. And this is Long Term Capital was a group of individuals that thought they were way smarter than the market, and they leveraged up a tremendous amount, unbeknownst to the vast investing public, unbeknownst to us.
Yeah,
And all of a sudden, you have the Russian economy collapse and the ruble collapses, and that flows back and basically sinks long term capital. And you've got to have, back then, Alan Greenspan went to all of the firms on Wall Street and said, all right, you guys broke it. You're going to fix it.
that's it.
And, all the firms ponied up money to bail them out. But again, that was something that was lurking underneath there that we had no clue about. And then it just hit.
And it is. And again, I think that's a good point again to reiterate that these things are very tough to see. But as you and I have been chatting quite a bit over the last few weeks, is there's just things that don't quite feel right or don't quite add up. So you just have to start asking questions and poking. Again, I can't reiterate this enough. It doesn't mean that this is around the corner. It doesn't mean this is tomorrow, right? It's just a matter of we need to be not afraid, but very aware and wary of what we're doing.
Yeah. And this is where, diversification really becomes critical. And if we go back to that whole 1999 period again, and I'm going to bring up some statistics because I think it's pretty interesting. The NASDAQ closed at the end of 1995 at about 1,052. It peaked in March 10th, 2000, at about 5,000. That was a 380% return from 1995 to 2000. And then we had the crash, and it
Mhm.
fell 78% over the next 3 years and did not get back to the 5,000 level until 2015. So if you went from 1995, the end of 1995 to, 2015, you had about an annualized rate of return of about 7.6%. Okay. If you looked at Berkshire Hathaway, and I'm just going to bring that up. I mean, everyone knows Berkshire Hathaway and Warren Buffett is retiring, but Warren Buffett is obviously a very smart man, and he was actually criticized during that time frame. And the reason why he was criticized during that time frame is because Berkshire Hathaway, it started trading the shares that we could start tracking at the end of 1996. And it, basically closed the year at $22 a share. On March 10th, when the NASDAQ peaked, it was at $27 a share, 27.40, and that was a return of only 23%. So 380% versus 23%. But
A
this
little bit
is
of a
where
difference.
it's interesting, because if you go to 2015 to the point where the NASDAQ got back to that 5,000 level again, you had a total return in Berkshire Hathaway of 11.8%. So 7.6% for the NASDAQ for that 20-year period, and a 11.8% annualized for Berkshire Hathaway over that period. But
But that
remember
that
that,
took a lot of patience.
heck yeah, it did. And again, I mean, I can remember Warren Buffett being made fun of on CNBC that he was a has-been. He didn't know what he was doing. He lost his touch and everything. But that points to the diversification. It also comes back and points to the fact that an asset bubble that is not leveraged up, okay, or one that spills over into the banks, that you can have very good rates of return in your portfolio. You just got to have that diversification. And, what we learned in 99, and I know it because I lived through it, we all started coalescing around the internet because we wanted to beat the market. We wanted to, quite frankly, stay in line with the market. And then none of us were wise enough to be able to pull away because we didn't know when the top was going to be. But that diversification, lack of diversification, is what made those years from 2000 to 2003 extremely painful. Diversification is the key. Now,
And that's not just between stocks and bonds. As you pointed out, it's different types of businesses, different factors that we started talking about that a little bit of. Are these more momentum driven, more growth driven? Is it more value oriented? I mean, there's all kinds of different styles and factors that drive markets, and those things shift over time.
absolutely they do. And whether it's like what you just said, whether it's diversification across the world, that helps as well. But again, as humans, as greedy humans, which I mean, fact of the matter is we don't want to see an asset class that is not performing as well as say the market is, or we want to beat the market. And that's fine. That's fine. But when we get to the point where we are right now, it is extremely difficult unless you are all in. And all in can end very badly.
Absolutely. Absolutely. Well, Jeff, with that, any last comments on that? I think as we said at the outset, we've beaten this idea of a bubble up quite a bit, but I do think it was helpful to bring some context today to the bubbles that we're really concerned about and where we're spending our time versus the bubbles that I want, again, not to be cavalier about it, but it's not that I'm concerned about it. We can work our way through those. But with that, I mean, any last comments here, Jeff?
Sure. I have a couple. One is I hope it pops sooner than later. You and I talk about this. I am hoping this bubble bursts sooner than later because the longer it goes, the more we are going to get intertwined in the debt market, the more the banks are going to get involved, and then the bigger problem that it becomes. And the other thing I would say, which is just, I think is very interesting, you and I have been talking about a recent book that's out, 1929 by Andrew Ross Sorkin. I'm about 15, 16 chapters into it. And what's very interesting, you made a point very early in our talk about people keep rationalizing why something can continue to go on and build.
Mm-hmm.
I would encourage every investor to read this book for multiple reasons. One, that fact that you just made, the rationale of why the stock market kept going up in 1929 and why it was never going to go down, the leverage that got pulled in to it, the banking industry and the titans, if you want to say, at Wall Street, who are supposed to be so smart,
Mm-hmm.
it kept frankly fueling this. And then we all know how 1929 ended. History is a great lesson for us, and it doesn't seem like we learned from it. But it's a great book. I'd recommend everyone to go out and get it, read it. But we keep managing the risk, and that's the best we can do. And I feel good about where we're at with our portfolios, but it doesn't mean that we're not going to have some turbulent waters ahead. That's for sure.
Yeah, absolutely. Well said.
Well, wish everyone a wonderful, happy Thanksgiving. We'll be back at it in another month. Hopefully, it will not be talking about AI.
We got to find something else to talk
We
about.
got to find something else.
At least for 1 month. We got to take a break.
At least for 1 month, right? Exactly. I agreed on that one.
All right. It was great, Jeff. Thank you. And again, wish everybody happy Thanksgiving. Look forward to chatting with you again here next month.
See you, everyone. Be safe.